I need some traction.
Hey everyone, Lloyd Lobo here, co-founder at Traction and Boast AI. Today's Traction webinar is brought to you by Boast AI, Launch Academy, and VanHack. If you're looking to expedite your hiring, get access to an international pool of 400,000+ developers with VanHack. Check out vanhack.com. Fantastic topic today. I am super excited. What the key to unlock more revenue from the same customer base. More and more companies are embedding lending into their products, not only to drive growth and revenue, but also to stay competitive. If you look at it, Shopify, QuickBooks, Toast, everyone's embedding lending, right? The future of fintech is here. Back in the day, the first wave was cloud. We don't say cloud companies anymore. Then came social. We don't say social companies anymore. Then came mobile. We don't say mobile companies anymore. And so I truly believe that in the future, we won't say this is a fintech company like artificial intelligence, like mobile, like social. All these capabilities that were novel innovations are today commoditized. Tomorrow, fintech will also be commoditized. And Jon Fry here, CEO of Lendflow, is on a mission to make that happen. What Lendflow does is it enables companies to provide credit and lending products to their customer base without writing a line of code. I am an angel investor alongside a few friends of mine. Lendflow has gone through Y Combinator, which is, I guess, the Harvard of startups. And part of that, Jon has built several successful startups in the lending space. And he's here to tell us all about how you can embed lending into your products to drive growth and revenue and squeeze out more revenue from the same customer base, increase your average revenue per customer without adding more resources, right? If you look at it, going from 0 to 100 million in revenue, every company initially has this one product where they own more and more of the customer relationship. And once that product becomes sticky with the customer, then they start adding more and more products. Now, if you look at what Shopify did or QuickBooks did, or Stripe has done, or even Toast, once they own the relationship where the customer is leveraging their product to transact or do some mission critical activities, you have access to your customer's data. Then what else can you offer that customer? What other products can you offer that customer based on the data set? And one of them is lending. And so here, Jon's going to tell us all about it, how you can do that. But first, before we dive into it, I'm tuning in from Dubai. Lots of huge audience here. Ontario, DC, Vancouver, BC, New York City, Austin, Texas. Fantastic. Maui, I'm tuning in from Dubai, and Jon has the awesome Austin skyline here. So fairly diverse audience, I guess, in terms of where we're tuning in from. Jon, you've done a few companies now. You've built and operated hundreds of websites in financial services, cryptocurrency, home services, restaurant, and fantasy sports while you were in college. What made you decide to start Lendflow? What else did you consider?
Yeah, absolutely. So, it started early. Thanks for having me on. Obviously, it's awesome to be here. I have all the people from all over the world joining today. So really excited to be talking to you all. It really it did start in college. That's where really, I made the commitment that wanted to build something great. And that's where the first experimentation come in. So everything I was doing on a daily basis was always a new concept for a new website or a new idea to try to build. And, I think over the years at post-college, wanted to continue on that path and, started to have a lot of success. All the skills I had gained, during those years kind of all came together in the financial services space and specifically in SMB lending, where it really took off. And so, when you find kind of that niche or that area where, there's a lot to learn, it's intellectually stimulating. There's a lot of problems to solve, and you have a lot of initial early success in doing that. And then you just want to go deeper and deeper. And that's what happened. It was the early part of last decade that really started to have success in the space with these SMB lenders, and then just started to go more and more deep every single day, week, month, trying to learn more about the space. And over time, over the last 10 years, you just start to see different angles and see what's needed, see what customers want, see what's going to bring in the next stage of innovation. And we've kind of had different stages over the years, and now it's time for the next decade, like you had mentioned, to make this a commoditized product where you don't have fintech, you just have companies that, it's the expectation that's offered within the product, because it not only does it drive revenue, but it enhances the product in such a way that the product no longer makes sense without it. So that's the high level, but happy to dig in deeper over the rest of the call into some of this stuff.
Fantastic. Now, you're not a first-time founder. You did a number of companies, you operated a number of websites. Why did you go to Y Combinator? Now, I understand Y Combinator is considered sort of the Harvard or the Stanford of the startup space. It's super hard to get into. It's probably easier to get into Harvard than it is to get into YC. So why did you go to YC? How did you even manage to get in? And what were your top learnings and takeaways?
Yeah, for sure. So I get that question sometimes, like, why? You already know how to build a company. You had done it before. But it's always a constant, it's always a constant learning process. And I think it's really important as, entrepreneur, as a founder, to really identify, to understand what you don't know. It's a world-class program. There's been incredible companies that have been built out of it. And it was incredibly valuable for me to fill in all of the different gaps, to gain a network of other incredible founders that you can lean on and learn from, to, identify areas you can improve and get better. And, it's really made me a much more well-rounded founder, gaining all of that from the program. So it was an invaluable experience. And I know there's a thought of like, oh, you're giving up a lot of your company, but, for me personally, worth it. The other companies that I had were, bootstrap, right? I didn't go out and raise venture funding. It's like, hey, I just want to sit down and build. And that's what I did through college, post-college. I continued on that. And I always knew that I wanted to, build a great product, a technology product, but there's a path to get there. There's a lot of learnings you have to do to get to that. And everyone takes a different path. And for me, that was bootstrapping more services based businesses at first, and learning the ropes that way, growing a team, learning about building internal products for yourself and your own internal customers, your employees to use. And then using all that knowledge to continue to take those next steps. And, I didn't have any fundraising experience. That was one gap where I learned an incredible amount about that side of the tech industry, and how that works and how to do that effectively, and still learning every single raise, every single round, every single conversation with investors, still learning more and more. But really that launching point to that was Y Combinator, and as well as a launching point to meeting other great founders that I get to learn from, and other great customers. Every single day is a conversation with someone building something really, really cool that I get the chance to learn from. So, and we got a lot of those people on here today. As far as what is important, I think at its core, it's just have conviction in what you're doing. Why are you doing this? Have conviction, and then remember who you're building for, what you're building for. I think Mike Tyson said, everyone has a plan until you get punched in the face. And I think that's
everyone has a plan until you're punched in the face. So move fast, iterate fast, ship fast, and iterate along the way, adjust along the way. Great stuff. So what were some key learnings or do's and don'ts from idea to validation to product market fit? I guess, firstly, let's start here. You had the idea. What tipped it over? Like, how did you get into YC? Any tips for founders?
Yeah. So, yeah, I do. I mean, they're going to recognize those things that are important, right? That's what they're going to hone in on. There's those two things. Like, why are you doing this? Like, it's just like I want to get rich quick, and I'm just trying to like, I just had an idea, a whim, or are you really committed and in this? Because being a founder is just a series of nonstop punches to the face that you have to contend with, and you have to be in it for the right reasons, because not only for yourself, because there's so many paths to exit, to quit, to give up, or to go another direction and not to see the vision through. And if you don't have that conviction, and you don't come from a place from like of deep conviction, then it's easy to take those paths. And I think they look for signal that could show that you're that type, because they understand very, very deeply what it's like and how challenging it is to go from zero to building a great company. So they look for that. I think, I applied multiple times. And when we started the company, we started like, we've had two like huge market like fluctuations. We started right before COVID. So we launched in Q1 of 2020. So that was pretty immediate punch to the face. And I applied actually earlier in the prior year, but then I got to the interview phase of YC, and they're like, it was March, and like lockdown just started, and they're like, so you're doing lending in the lending space, and like lenders like are not lending any longer at the moment. Are you sure? Like you want to do this? And they ended up, saying like declining. And then when I came back the next time, this is the third time, it was like, okay, like you actually made it through all of those 6 months of like kind of this pandemic and this catastrophe, and like you made all this progress. And that's what they're going to look for. You're probably not going to, I mean, like you're not going to get really accepted your first time, or it's much more likely it's going to take multiple times. And so if you show progress now through each application, and that you're moving in the direction and you're doing it anyway, regardless of you get into YC or not, that's I think what they hone in on. So yeah, I'd say you gotta be able to show that progress. And I think they have startup school where I did updates for like 18 months on the startup school thing before I got in. So like they look at that stuff. It's like, wow, like 18 months of updates on a weekly basis. That's the stuff they look for.
So you were involved in their community, you got into their startup, you did the startup school, although you didn't get in, you showed progress. Traction
Yep.
trumps all, no pun intended, but success ultimately is a couple things done, one or two things done consistently well over time, doing it better and better, 1% better and better. What was the key part of your progress? Was it customer traction? Was it product sort of maturity? What was it that tipped it for them?
I mean, yeah, I mean, it was a combination of those things, like being able to drive revenue even when there was not much revenue to be had in lending, and to be like, resourceful. Um, we had to do a lot of scrappy things to get through that time. Like we had our revenue growing, then it kind of tanked, and then we had it come right back up. And I think showing that resourcefulness and like that ability to be nimble and to find ways to make things happen regardless and bring on new customers during that. And we did some PPP stuff and partnerships that we did. We did asset-backed products. We kind of were doing all these different things. So it's just a combination, customer traction. The product went a lot further. We like re-architected the whole thing, made it bigger and better. Through all of this, we learned a lot. So kind of a little bit of all of that, I'd say.
Yeah. Fantastic. Awesome. So let's get right into the topic for today. You got some traction. You came up with the idea because you were in the space. You said you did a few bootstrap companies in the lending space, which was manual. But when you do things manually and you serve customers manually, one thing comes out of it. The sort of workflow, right? What is the workflow to do manually to deliver this outcome for the customer? Now I can build automation to make it easy and simplify it. And today, now you're democratizing lending by enabling people without any code to embed lending right into their products. So first, let's start with what is embedded lending and how it works. Why is it important?
Sure. So I define it as, offering a credit product um, within a software's user workflow. That's embedding it not only into the product itself, but also embedding it to within user workflows, to enhance the experience for the end user. So for me, that's really what embedded lending is. And now we have a lot of data to back that up because, as you said earlier, it is about driving more revenue per customer. But it's also about all those second order effects. It's about enhancing the other features that you have. If you're getting paid for an invoice, getting paid faster on that invoice. If you have something to pay for, being able to finance the purchase of that, finance that purchase within the product. You know, if you're owed, receivables, or you have payments, or you're able to offer lending to the end customers, like all of these different things enhance the experience for the user. They also drive revenue, but they also may drive transaction volume, or they may drive like additional usage of a feature. So that's kind of how we look at it. And you can see that through the data that says the more that it's embedded, the more that it's in a user workflow solving a problem, the higher and the higher the conversion rate gets. And the more usage of that, the kind of that feature or that part of the product happens.
So let's dive into the different kinds of lending products that one can offer, maybe.
Sure. So, I mean, there's a pretty wide variety of credit products, and you have companies building new ones all the time. I think one of my favorites right now is Flexport, just because it's really it's pretty timely what they're doing. You felt everyone here has felt over the last few years the importance and the value of the supply chain. When that is disrupted, then it's very disruptive to all consumers and businesses, because they can't get things at the same speed, or they're more expensive, or they're harder to acquire, or there's delays. And I think everyone's felt that. And so they come in and help solve that problem through software. And then they can take credit, and they can embed it into those user workflows. And like that has a big impact. That makes companies operating on their platform have less cash flow gaps. That means they can invest and they can move more quickly. They can take on more work. They can ship more products, all these different things. And you see that with products like theirs. You see that with products like, some of the first to do it, the real innovators in the space, like Square. It took them years to kind of build out that product, to get that to market. And then Shopify doing it years later. Like those were really hard to stand up. It was really difficult. There's over the last 10 years been a lot of manual process and manual work that's had to go into like issuing their credit products. There's always been kind of the dream of that automation and like making all of that happen, but kind of allowing that to come to fruition has been a bigger challenge, just because in SMB lending, there's a lot of hidden complexity to it, where there's a lot of risk for you if you automate a lot of the process, but that automation means maybe you're taking shortcuts or not doing a lot of the very important work that some of the earlier companies in the space learned the hard way. Now you're getting access to all the data APIs. Now you have more access to data. There's more tools to make a lot of this stuff easier. And now it works well with other features that have had a lot of success too, like payments. So that's kind of what's happening in the space, and like why now is the right time for it.
Certainly. I talked about Toast, QuickBooks, Shopify, their service type. I talked about many, many of them. And if you look at sort of Bessemer Ventures always publishes growth laws and what's happening in the market and state of the cloud. And one of the things they're super bullish on is the whole embedded fintech space, right? Once you own the relationship with your customer, what else can you squeeze out? So if the customer is using you to transact, if like a company like ServiceTitan, which is in the maintenance space, where their customers use it to manage, sort of becomes like a system of record, right? Their customers use it to transact with their customers, and offering other fintech things like payments, lending, insurance only makes sense. So they can squeeze out more and more of the relationship. I say squeeze out, which is a really bad word, but really what they're doing is they're offering more and more value to their customers. And in return for offering more and more value to their customers, they are increasing their average revenue per customer. So like if a customer of theirs, say they have a data set from the customer, you have a data set from the customer, what else can you offer? I'll give you an example with Boast, my company, right? So Boast AI automates tax credits. So globally, hundreds of billions of dollars are given in R&D tax credits to fund businesses. It's a manual, cumbersome process, right? You have to do a year of R&D, then you have to apply it with your taxes, and then the government gives you that money back. Now that whole process is like a year, right? So you incur a year of R&D, then you apply for it with your taxes, and the government processes it. They may audit you and give you that money. So you're sitting on this valuable asset. Now, if I tap into your data and I know how much money you're spending on R&D, I also know how much you could qualify for because I can underwrite it. Why not? I may bring you forward that 18 months later money today. What could you not do with that capital, right? What is the cost? What is the value of that capital if you can get it today to spend today versus 18 months later? So the same thing with receivables, ARR. If you can roll forward cash in your business today, cash is king. What can you not do with it? You can finance growth. You can finance other things that are relevant for your business, right? And it's cheaper than equity. So let's dive into that a little bit. What is the ideal customer? Like what should you be doing to benefit from embedding lending in your product? Like, I mean, sometimes it can be way out there where it's not a fit, right? But when does it actually start becoming a good fit? Like maybe walk through some use cases of customers. I just gave you my use case for Boast AI, right? Hey, we own the relationship with the customer. We're doing R&D credits for them. They get them. It takes a long time for our customers to get the money. I can bring lending at the point of sale where they integrate their tech and financial stack. I know right away how much they're spending in R&D. I can do an assessment of what they could qualify for. Hey, do you want to take that money now versus wait? What are some other use cases like that are more common? This R&D tax credit is more niche, but what are some common use cases across your customer base?
For sure. I mean, you see it, with, Procore, who's a customer, those construction companies, they need to go out and purchase the materials, the supplies, pay their payroll. They have to pay marketing expenses and sales expenses to win the projects. There's all these upfront costs. Then you have to go in there and build the project, and you may get paid at the end. You may get paid kind of progress throughout, but there's still more costs up front to buy all of those things. And then, you get paid at some point after that. And this means that inherently it creates a lot of cash flow gaps in the business where they're not able to invest or they're not able to take on more projects, or they can't grow because their capital's locked in to executing on this project, and the cash in may come in from it, once they invoice, 30, 60, 90 days plus days after the invoice. But like that invoice is usually only coming after they've completed the progress on that project. That may take, months or more. So that's one example where they saw that opportunity and built a materials and supplies financing product to address that. So now you can finance the purchase of that materials and supplies. You have more cash flow, and then you're right. You can go in and invest that in taking on more projects and growing the company, or investing in assets that you can, that'll provide value, a long value over the life of those assets, like that equipment. So
for the audience's benefit, Procore is now public. It was a Bessemer Ventures backed company, hyper growth. It is a construction management software that sells to contractors and construction company owners and subcontractors to manage their entire construction processes, like bill of materials and projects and maps and plans and everything else. So as a function of you using Procore as a contractor to manage your construction projects, now Procore has the data that you're using, right? Like they basically have access to your data. Who are your customers? How much are you charging your customers? What are the costs of the material? So Procore is sitting on top of all this data. And so now they're saying that, hey, you know what? You can finance some of these projects. Customers are going to pay you later. We know what they're going to pay you later. So we'll give you this money now. Or you want to finance building materials or project materials, those kinds of things. Or you have customers owing you money and you're sitting on these receivables. you can finance that. So you can offer a lot of these things. So Procore offers a lot of these different types of financing to their customers who are contractors and who are leveraging Procore to manage their projects end to end. And Procore has the data from like receivables to building materials to everything else. So hopefully I explained how that fits in there or summarized it. So let's dive into, what are the actual benefits? Now, the benefit to the customer, we understood, right? Like, so you have a product that you sell to businesses or individuals to do some sort of workflow, some transaction. You're collecting this data. Based on this data, you can then offer point of sale or embedded lending to these people because you have that data and it's valuable. Now, we understand the value to the customer, the end customer, meaning the end customer of the software company that's offering embedded lending. What is the value to the software company for offering this? How much extra margin revenue? How much can I increase my average revenue per customer? I was with Matt Harris, partner at Bain Capital, and he seemed very bullish that this can be 2 to 5x LTV. So walk us through that math a little bit.
Yeah, certainly. And to your other point, it is about, the data. It's also the data for underwriting and credit decisioning. It's also for the data about the timing of the product. And that goes into understanding by the workflow that they're engaging in, like when a product would be useful. And so again, it comes down to revenue 2 to 5x, but if you enhance the product and you enhance kind of the usage of that workflow because you're improving it or enhancing it in such a way, then, that captures a lot more value that may not necessarily go into the revenue number. But looking at the revenue, like you look at originations, maybe, I can give an example, Square, they probably did, 2.5 billion in origination on their platform, but Shopify is probably a bit more than that now. I would say annualized their products is probably about 24%. They just probably, I think they're shorter term, like 6 months, maybe 12%, 6 months product, annualized 24. So if you put out 2.5, that's going to come over a little over 3 billion in receivable, like 3.1 that you're going to get back. So that's, about 600 million. And of course, you got to subtract out your defaults and your cost of capital and your other expenses from that. But you can see like how significant that's $600 million in additional revenue from the yield from issuing those products. And, PayPal's probably originating, 5 or more billion now. QuickBooks is up there. I'm not familiar with how much they're originating, but you have Shopify, at least, a quarter, maybe a quarter, they did $1 billion. So at least I believe. So they're probably in the 2 to 4 range. Seeing similar econs, like they're really interesting too, because they're a great example. They're doing the payments flow. They're earning on the yield from the businesses, the origination to purchase ads, purchase like inventory, purchase financing, all these investments that are required for these e-commerce businesses. And they're also earning on all the flow. So they can invest more, they can drive more traffic, and then they have buy now, pay later, consumer loan on the point of sale. So that's enhancing the conversion rates there. Then that creates more flow, creates more investment in ad spend, higher conversion rates. And you can see why those merchants have such a big advantage and why the Shopify captures so much of the value in that revenue. Not only, let's say they did 2.5 billion, they earned about 600 million on in additional revenue on just the merchant financing piece. Then you have all the payments flow as well. Then you have all the additional conversion rates from all the purchases that happened, and you have any revenue generated from like kind of that consumer loan product as well. So that's how it can all add up. Just to give you an idea, for companies not that as large, on the smaller side, you don't need that much. We've had a company with just a few thousand companies generating an additional, over $1 million in additional annual revenue without really adding any meaningful, significant incremental cost. And right now, when companies are being pushed to be more resourceful, and it's more important than ever. And you're getting pressured by the market, and maybe by your board or your investors to be that way during the next kind of this more recessionary period. Then to add that additional revenue without cost, you could probably, for each 1,000 users, if they're paying, you could probably originate, maybe $250,000 a month potentially. So, that can be pretty value add to your customers, and be a nice additional revenue stream as well. So just to give kind of the angle from the very large companies down to the smaller ones too.
Yeah. And, if you look at it, 500,000 or $1 million additional revenue, most companies ignore that. But really, without cost, that 500,000 or $1 million in additional revenue is straight to your bottom line. To generate that kind of bottom line, you have to get maybe 4 to 10 million revenue given your net profitability. Right now, in QuickBooks case, it's the obvious one. They collect all your bookkeeping data, so they know your receivables, they know your outgoings in and out of your business, they know your ARR, so they can finance a whole bunch of things. And that's what based on the bookkeeping workflow, they enable accounting firms and bookkeepers to offer lending, right? Like they basically have this QuickBooks Capital. They went a step further and launched this big fund, QuickBooks Capital. But a smaller company that doesn't have that access, but has the customer relationship, can offer this, right? So, Jon, who is your target market? Is it corporate America? Is it B2B? Is it any organization? Like, what is the ideal customer profile?
Yeah, definitely. I mean, we touched on it a little bit before, but we love, software companies. We love both vertical and horizontal options. Examples of horizontal, and I think they work for us at least a little bit less well, because you're mixing so many different types of businesses. That would be platforms that do like accounting that you mentioned, that's serving accounting for a function of the that's needed for the business across many different types of industries, or payroll or payments companies. We've seen a lot of success there, but getting into the points you mentioned earlier, I think really an area we're super excited about is vertically focused financial services credit products that can be built, because now you get to go very, very deep on a user workflow of a vertically focused software company. It's all one type of business. You can gather all the data points on that business are kind of being locked in this software, and unlock that value for credit. And you have the chance to really innovate and build completely custom products that makes the most sense. Rather, when you go broad against many types of businesses, it's kind of always the same cookie cutter product. And so it's really interesting to see what software companies will identify, what user flows they'll identify where they can embed a credit product and create something completely custom that's perfectly matched, both from a data perspective and the decisioning, but also from the timing perspective of when it's presented and how it's presented within the flow for that company within that industry. So those are kind of the two different areas. The other characteristics, just a few thousand users, like I said, for maybe 1,000 paying customers, like $250,000 in origination, maybe like $25,000 in revenue, potentially for the software company, at least the ones that we work from that. Features that you could work well, that play well, like payments. So if you have that already, if you've already done embedded fintech of some kind of the more that you have there, the better. So if you've done payments, it works really well side by side with that. If you have invoicing, if you have the purchase on your platform, if you have a purchase or a sale going there, that could be another really good signal. So, we're focused on SMBs. So software that's serving those SMBs for us, that's our focus at the time. So, typically the more the better, but, most of those SMBs need to be generating about, at least about 60,000, $5,000 a month and greater, about 60,000 and greater in annual revenue for it to really be start to make sense, and for them to have a lot of better, good options. It gets much better, about $20,000 in monthly revenue and greater, where they really open up kind of the next tier. But a few of the things that we look for.
Now, Sanjay asks, am I correct in understanding that the SMB use cases, like a contractor won't be able to finance a large construction project, but most likely small jobs. Can you break that down a little bit with like Procore example?
So maybe say it again. They won't be able to finance the whole project, but maybe little things. Say one more time.
Yeah, like break that. What he's wondering is, this is targeted at an SMB use case, meaning like a contractor, for example, on Procore, they might not be able to finance a large construction project, most likely small jobs, or is that incorrect?
I think we see a lot higher volume of the smaller projects. The SMB, where you can provide more and more value, is the longer tail you go, because they have less access to capital. And so you talk about democratizing capital. If you're a large company that has large construction projects, candidly, like you probably already have like bank financing lined up for that, or was required for you to get to this point. And so first, like we can offer those products. We obviously have relationships with banks, but if they're already bankable, and that's a tough bar to pass, but once you're there, there's less value for us to come in and say like, hey, like here's another bank loan. It's kind of exactly the same bank loan, but we're gonna offer it and enhance it a little bit. There's a lot more, and there are good opportunities to do that. We do offer these bank products. It's just, it's a smaller segment of the user bases, maybe 5%, 10% are kind of in this tier. And then you have the 80, 90% plus where they haven't had any of these options. And so we've seen more volume coming into the ones that have smaller projects, that have less access to financing, and help them grow so they can level up and they can get approved from the SMB product, then get a near bank product. Then they can move up from the near bank product to getting a bank level product. And so we've just seen a lot more volume there because there's a lot more value to provide, and it kind of matches with the vision of democratizing capital and making it more accessible to all those SMBs.
And then from a sort of customer-based standpoint, right? So like just to explain the flow, Lendflow is a product like Stripe, like lines of code you embed into your product. Your customer uses it, and your customer uses your product. Let's say you've collected some data from your customer. You're like, hey, based on your data, you can qualify for a loan. Would you like to take it? Now, are you selling to B2B software companies or B2C software companies? Procore, or you're selling to both? So for example, Procore sells to businesses. Boast sells to businesses. Right? And so Procore sells to contractors who manage projects. Boast sells to businesses that do R&D. And so we look at these specific things, and there's lending. But do you also have customers that sell to individuals, like consumer-based companies that you can offer these products to? So consumer lending.
Yeah, so there's a few pieces to this, and I'll start kind of from the top, because we're not actually providing the loan product, right? We're just kind of the technology and the infrastructure. And so when you're thinking about launching a credit product, you have two options. Really, what it comes down to is you can either you want to build it yourself, build your own credit product in-house, or you want to offer a credit product from a third-party provider. So with us, you kind of have the option to do either one of those things. We can help you build it, building out the credit model on our platform, pulling in all the data you need, automating all the decisioning. But also, if you're not ready to take the step, or you want to kind of do some combination of mode, we have customers that maybe want to, offer a credit product to this specific segment of their customers, and for the rest, they want to offer a third-party product. Then you can just embed, a third-party credit provider from a bank, from a non-bank lender, a fintech lender, a specialty lender. You can provide those and kind of white label the onboarding experience for them and offer them within your product. So when you get to consumer loans, like we do have new customers that are coming on, but it's not for kind of embedding a third-party credit product. We don't provide that for consumer, and that's not really the direction we'd like to go. But if you want to use decisioning, to offer a consumer credit product for issuing a card or doing underwriting or building a credit model for offering a consumer product, these are the types of customers we're seeing use our tools for those same things. Because what applies for SMBs? Well, when you underwrite a commercial business, SMB, or commercial finance, then you have to underwrite the business as well as all the owners in many cases. And the longer tail it goes, the smaller the business, then the more the owner is a focus. And so we have a lot of that functionality because, for the smaller deal sizes, for the SMB-based products, you're still going to need to do those checks on the owners, which carries over well to consumer. It's not a big area for us, but the decisioning side of our product does support that.
So let's get into the flow here, because there's a bunch of questions here. Who lends the money to the customer, and who is responsible in the case that the customer can't pay back? So before we get into that, I think it's important to understand the flow. You want to offer lending in your product. Let's say you sign up with Lendflow, you embed it in there. It's end to end in the sense they'll help you determine the kind of lending product you can offer to your customers based on your data. And then they'll go and figure out, or Lendflow will go and figure out or structure the deal with the lender, right? And then you can facilitate that whole transaction end to end. So there's all these banks and credit unions and credit facilities. Lendflow will go and find the best rate, help you figure out the product and manage the whole rails and infrastructure in between. So then you can offer the right product to your customer and lend. Did I summarize that okay? I'm like doing your sales pitch when I'm not trying to, but
yeah, I mean, it's pretty spot on, not trying to be all salesy here, just like answer the question, give all the good information to the people who join. But that's right.
I'm bullish on this, by the way, because Boast AI is a fintech company, and for a long time we are workflow, meaning automating the application for these government incentives and tax credits. And they're like, you can also offer lending, and then you become fintech, and you basically adding 2 to 5x to your LTV, and so that also improved our valuation and whatnot. So I'm really excited about the space more. I'm not trying to do your sales pitch, but let's dive into how that works, and then actually who lends to whom is a very important thing. Like, who handles the risk? What if the customer can't pay back the loan? I think these are some questions that we need answered.
Yeah, definitely. So, I mean, it depends how you want to set it up, right? If you want to offer and there's kind of 3 primary ways, at least with us, and you can go out and find, there's a lot of different platforms offering some of these services, but it's really, you want to build it in-house. And if you do, then you need to go raise from a credit fund and put together a facility to issue a credit out of. Now you could immediately sell those. You could set up as a forward flow agreement, or make it asset backed. And so there's a little bit of nuance to that, but there are different structures that you can set up, and you need to go get with the credit fund to do that. You could issue credit from equity. We sometimes see that, but as you said earlier, Lloyd, that's not really ideal. Maybe as a starting point to kind of get up and running, but issuing debt from equity, I would hope that you're going to be able to invest in the growth of your tech startup and earn higher growth and returns than the yield on a debt product that you're issuing. And so it makes sense to do that. It just takes a little bit, experience, right? And we can help with that. You have to put together the flow. You have to, there's different risks. The origination risk. Can you really originate business? Do you really have the expertise to service? And there's things a little bit more complex that come into play. But then the flip side is, there's companies like ours that make a lot of these complexities a lot easier. And then you're going to earn more of the econs. And whether you want to start there on day one or work your way there, we kind of want to give you the option to do both. And kind of earn the reward is you can go from 3% to 10% to however many percent of the yield from the product you're offering. The other one is you just want to offer from a third-party provider. Obviously, you'll earn a little bit less than this, but there's a lot less complexity. The end credit lender is really going to be responsible for servicing. So if there's a missed payment or non-payment, we will help and stand between and manage the relationship, and that will be under your brand and on your behalf. But we can call them and say, hey, let's get you back on track. We can help them put together a plan. But after a certain amount of days, sometimes it's 60 or 90 or whatever the lender is defined, they're going to have to put the account into collections. And then the lender will, in their servicing team or collection team, will be reaching out directly. So that's how that works. Now, there is kind of a middle ground where we have what we try to make the best of both worlds, where you have kind of a lender, a provider of credit doing all the back office, which includes the servicing, the collections, all of that, but building a program with them where we can white label everything from the onboarding experience to the contracts to the repayments, the servicing, but they'll handle all of that, and then you can invest on every individual business out of your credit fund or out of your additional cash flow into each individual deal, anywhere from 0% to 95%, and kind of participate in the products and earn yield from the products without having to build a lot of that back infrastructure for servicing and collections. So those are a few of the options that are available. I don't know, did I cover it? Any follow-ups?
That covered it, but it might have confused a few people. So let's unpack that a little bit. What I guess the heart of the question ultimately is, who is on the hook for paying the lender, right? So you have this white labeled embedded lending offering. You're providing value to your customers. Now you're like, hey, I have your data, Mr. Customer or Miss Customer. Based on this data, you qualify for either buy now, pay later, or a term loan or whatever. And we'll dive into all of these. But now say the customer doesn't pay back, who's managing that risk? I think my recommendation from my experience is this money, this lending shouldn't sit on your balance sheet. It should sit on off balance sheet. But then it's the lender that if the customer defaults, the lender takes the hit, or does the company that's facilitating in between take the hit?
Yeah, it's a great question. So if you're providing the credit product yourself and you raised from a credit fund and you're earning more of those econs, it's up to you to service it in many of those relationships. You're also responsible for servicing that account, which means even if you resell it, you're in most cases responsible for some percentage, what's called an advance rate, some percentage of the losses. That may be, you could maybe get it to 0%. I don't know, it may be tough right now to do that, but 10, 20% is pretty standard, where you'll be on percentage, you're kind of capped at whatever amount you negotiate. It's probably the most important term that you negotiate on one of these deals, candidly. It's not really the interest rate of like the cost of capital. Actually, more important is typically the advance rate, or how much of the losses that you'd have to eat of that. And it's kind of in a partnership with this credit fund. If you're offering from a third-party provider, then it's all them, right? It's you're earning, and you're going to earn on each kind of credit product that funds without taking on any of that risk. There may be a 30-day clawback or something if they default in the first 30 days. But other than that, there's really no risk that you're taking. And even if they default and that they have to go into collections with that third-party lender, then, it's not really any, other than you want your customer to have a good experience, like it's not going to be a financial hit to you. And if it's hybrid, it just depends on how much you participate with the lender partner in the deal. If it's a 50-50 split on both the risk and the reward. So it just kind of depends on what you decide to participate with the lender for that.
Definitely. And now with the product like Lendflow, people can start off with the whole white label experience, right? Use a third-party lender, validate the offering by getting your customers, offering it to your customers and seeing if your customers are getting value. You get validation. And then as you have more and more validation and more customers are taking it, you might consider taking on a little more risk, maybe raising a fund and just using Lendflow for the decisioning and the credit and the risk management side of things. If you take on more risk, of course, you keep more reward, meaning you keep more percentage points and you keep more margin. But if you're offloading entirely the risk and everything else, you may have a little less margin, but it's a great way to at least validate the market and add some basis points and add some revenue. So from your customer base that is leveraging Lendflow for entire end-to-end, meaning using a third-party lender, then using all the decisioning tools and providing a whole white label lending experience within their products, how much money can they make for every maybe $100,000 that are lent? How much origination do they need to do to make $500,000 or $1 million in revenue?
Yeah. So great question. So let's break that down. I think for $100,000, average is going to be a little over 3%, between 3 and 3.5%. Just for easy math, we'll do 3. So it's $3,000 for every $100,000 originated. So to get to $1 million. All right. So we just need to break down that math and see how much is it gonna take. So 3,000 for every $100,000.
Yeah, 33 million. Sanjay did the math here. It's divided by 3%.
There we go. Boom.
Sanjay is a little better than us on the math, but yeah, it is. It works out to basically 33 million, right? Is the math.
That's right. And so, how many customers is it really going to take you to hit that mark? For many of the products, they can take out financing multiple times a year. We see that as is the most common. If it's working for them, they have these cash flow gaps commonly throughout the year, so they're going to take them out many times. But again, on a monthly basis, kind of we went through it a little bit before. 1,000 customers, usually that's almost like $200,000, maybe $250,000 in origination. So you can just do that math and say, okay, to get to 33 million, how many really customers do I need to have for that product? Other considerations are just average deal size. It's about $25,000, $30,000 on average across the SMBs that we see. But then we have customers like Flexport we talked about earlier. They're doing like $1 to $10 million lines, right? So they're a lot larger. So to get to that number, you need a lot less because they're such large products. So it just kind of depends.
Depends on your customer base. It depends on if you're selling enterprise, mid-market, or SMB, right? Like Sanjay brings a good point here, embed lending to auto dealerships. So let's say you have software that enables auto dealerships. You can embed lending to auto dealerships, and you probably make that money with 200 is like he's saying, or retailers, right? You're providing technology to enable realtors. Sorry. You can get that with a lot lower. Awesome. I want you, as we close out and getting close to the top of the hour here, the difference between offering options such as, let's break this down. What is buy now, pay later? How does that work? B2B payments, net term loans, credit cards, like break that down a little bit for us.
Yeah, we have customers that are issuing, all of those different products. Buy now, pay later is, you both have consumer, like in a firm, or you have, companies doing this for businesses as well. So Balance is an example of a customer building this product. So it's been really cool to see that. It's essentially just giving financing the purchase of something and allowing you to spread out the payments for that purchase over time. And so that could be a really good fit if you have, some type of purchase happening on your platform where you can reduce friction and make it easier, increase conversion rates of that purchase occurring. So that'd be a really strong one there. Other examples are cards. So A2B is a great customer for us here. They're issuing fuel cards for fleets and for transportation and truckers. And so, again, this is just kind of a line that they put onto a card to, put for spending, for in this case, fuel. Another one is in the construction space. We talked about materials and supplies earlier. This is another area we see, or, kind of vertically focused cards. There's horizontally as well, but a lot of the companies that we've seen come and start to build have more vertically focused ones. So that's another example. And, just like you have to underwrite for a credit product, you have to do the same for a card. And so you have some type of purchase. Not only could you allow them to spread out the payments for that purchase, but just to purchase on a card. So you can earn on the interchange as well as earn on the yield from that buy now, pay later product. Let's see, a term loan. Maybe a line of credit. Those are, other examples are revenue-based financing. Again, as far as underwriting for issuance, pretty similar. Term loans are typically longer term, maybe over 2 to 5 years. And so they're usually more spread out. It's structured as an actual loan product. It has an APR, could be anywhere. Usually we see like 5 to 15% range for those. lines of credit, you can open it up and you only pay interest on the days that they're outstanding. So for flexibility and quick access to cash that you can quickly pay back, they make a lot of sense. This one's been really popular lately on our platform. We've seen a big uptick in these lines of credit. Just people that wanted to open them up, even if they draw just a little, just to have that quick access to capital in case they need it, right? So you can just have kind of that line outstanding there. And when you need and you have that gap, you can take it. And as soon as you can pay it off, you can pay it back, and you only pay interest on the days that you had that credit, that balance outstanding. So that's a big one, especially over the last few months, customers. And then revenue-based financing is basically just looking at your past receivables, historical projections. It's a shorter term product. This is like the Shopify or Square type product, where you're taking historical receivables, projecting that into the future, and then purchasing those receivables at a discount and paying them out at the present time for that. Those are usually over 3 to 18 months or so a little bit shorter term, and those repayments can come back like daily, weekly, or monthly. They can come from the bank account or be split off from the payment rails if you have payments integrated as well. So I don't know, just the quick and easy on those
the quick and easy. Lendflow currently only works in the US, right? Or does it work Canada? Does it work international, or it doesn't matter?
So we're primarily most volumes in the US. We also support Canada. So we have some great customers from up there. There's a lot of potential. We're very excited about, what's happening there in fintech. And we were in Vancouver at the conference and got to saw a lot of other great companies. So love what's going on there. We support Canada too. We'll look to expand out in the next couple of years. Probably Australia and the UK are other two really interesting markets that'll be upcoming. And then, of course, Europe and Latin America. So, but those aren't available today or the rest of the year. 2023, 2024 plans, though.
Definitely. Folks, any outstanding questions, or if you want to talk about your specific use case, feel free to drop it here. We're getting close to the top of the hour, so I want to make sure if you have a specific use case, just describe it in the chat. Like, hey, my product does X. This is what our customers use us for. This is the type of data we collect. What kind of lending product or credit product can I offer? How much money can I make off of it? I think if you want to drop that in the chat, feel free to do that. Otherwise, Yvette here dropped another webinar from Lendflow, more like a demo on September 15th. Feel free to join that, or check out lendflow.com. I'm sure you can message Jon at lendflow.com, and he'll tell you all about it as well. But essentially, to summarize here, Don asked the question: is Lendflow value add the facilitation of the finance process, or is there some risk reduction for the finance provider as well? So there's like three people here, right? Like there's the lender, right? I'm now summarizing this because I'm trying to, I'm like sort of representing the audience here, right? So you have a customer, so that's one part of the equation. You have the lender, and you're in between. Now, to facilitate financing, providing capital to your customer, so you take a cut out of it, there needs to be some way to understand the data and the risk involved to make sure how much they get and at what percentage. And Lendflow facilitates that whole relationship. So that means the outcome for the end customer is they get money, of course, at the best rates possible. If they can't get a good rate from the bank, the outcome for the software company with the customer relationship is they get a margin, they get to provide value for the customer, and they don't get to own any of the risk. And the value to the lender is they get a reduction in risk, and they get more customers and margin because their business is lending. Did I summarize that okay?
Yeah, that's right. Nailed it. Spot on. Love it.
Oh, yeah. I should come work for you guys, although I'm not getting paid. So awesome. Cool. So here, Emotu asks, we offer delivery service to e-commerce merchants. What kind of loan product can work for this? So Emotu, I hope I'm pronouncing it right. Sorry if I butchered your name. when you say delivery services to e-commerce merchants, describe the workflow a little bit. Like, what does that look like? What does the use case look like? Who is your customer? The customer is e-commerce merchants. But when you say delivery services, meaning you're offering last mile delivery to them so their products can be delivered to their customers. Describe that a little bit. We pick up and ship out the orders for the merchants.
Okay. Yeah. So ship out the orders for the merchant. So you have a user base of SMBs, e-commerce SMBs, that are using your platform for shipping. I like this exercise because we can talk through like what challenges or like points of friction could they remove? Like what's going on? Well, when they need to ship something to an end customer, that means there was a purchase made. There could be really interesting data that you could potentially have maybe on inventory levels that could be interesting. If also on data that's being sold and demand for particular products. So that could mean maybe two things: an inventory purchase financing product that could be interesting for them. There could be really good data potentially on that. And if there's not, maybe there's a way that you can start to gather and accumulate that data for purposes like these, and also for investing in ad spend. If there's data points on what product is selling best in what geographies, that they're shipping all of these products to, New York. Say, okay, well, maybe it makes sense to invest in ad spend in this market. This is where you're delivering a lot of these products, and there could be a financing product to purchase ad spend. Or, and the other example, purchase inventory. So that would be something, I think those are two products that potentially could make sense for this. Yeah. Any other thoughts on it, Lloyd? What do you think?
Yeah, and definitely, you said you don't get the origination data, right? So you could start with like, if you're financing inventory, or you're financing the ad based on, you make this available in your product. Hey, I'm seeing you're shipping a lot into New York. You could get $100,000 to run ads to get more customers in New York, or I'm seeing that you have such and such inventory. Do you need to finance more of it? But then you can always ask them, hey, if you add another data point, if you add your origination, or rather your order generation data, just link your order generation data, and I might be able to give you more money, or your overall rates will get better. So right now at this rate, you qualify for, at rate X, you qualify for inventory financing, and rate Y, you qualify for ad spend, ad financing. But if you link your order generation data, you could not only get these three other products, but your overall rate will get better. So it's a way to get another data set, which also makes that customer sticky. And that's how we look at it at Boast, right? It's like, hey, we collected your technical data and your financial data, so we can offer R&D financing of R&D credits. But then, hey, if you also link your QuickBooks data and maybe your Salesforce data, then I know what your recurring revenue is. So if your ARR is 10 million bucks, can I not give you 1x ARR or half X ARR? If I know, like, for example, if I know your monthly recurring revenue is $1 million, let's say, right? So your monthly recurring revenue is $1 million, and I know your churn now based on your customer success data and your QuickBooks and your Salesforce. I know what your churn is going to be. And like, say you have no churn, or your high NRR, like many SaaS businesses, then I can say, hey, I'm going to finance 6-7 times MRR, just right in there. And I'm just from them linking another data set. And now all of a sudden I have a whole nother product, right? And squeezing more margin. And there are so many MRR financing companies, like monthly recurring revenue financing companies, that are just doing that. But I already have the relationship, so I can offer an additional data point. So I can offer an additional product based on asking for another data point. And how many people wouldn't link it, right? Because they're already there. Hey, you qualify for 100,000 in inventory financing. You qualify for another 100,000 in ad spend financing. But if you link your order generation data, then you could qualify for these three other things, and your interest rate is going to be, your overall rate is going to be better as well. And then now the customer is like, hey, I get this pool of capital to do a bunch of things. You, as a software provider to this customer or this vendor to this customer, you get more margin. You get to squeeze out more value from the customer. You got more data from the customer. So as a virtue of, you're not just taking data, but you're providing them value. So you also became stickier. That relationship became stickier. Awesome. Jon, thanks for joining us. I geeked out a ton on this fintech embedded finance because that's my jam and I love it. And folks, hope you got value from this session. Check out lendflow.com. And also they have a webinar going on, and I'm going to drop it because Yvette sent it to me, and I guess she's just sent it to hosts and panelists. So Yvette has posted this link here, the build.lendflow.com/Lendflow demo days, where you can see the product in action and ask any technical questions. Next week, we have a great session coming up. We have Vinay from Loom, the founder of Loom. He's going to share his journey from going nearly bankrupt to 14 million users and 1.5 billion valuation. We also have all the Traction Conf recordings on our channel right now, and they're at thousands and thousands upon views. We've got 30 plus sessions from C-Suite, from Atlassian to MailChimp, on how to get, keep, and grow customers, how to raise money, how to build products for hypergrowth, how to build and scale your teams. So check out the Traction YouTube channel. We got 30 plus sessions from our most recent conference 2 weeks ago. And then, of course, our Spotify and Apple channels for our podcast recordings. Stay in touch and stay tuned. We're going to send out the registration page for a webinar with Loom's founder on how he maxed out his credit cards and was inches away from closing the door to his company, to growing to 14 million users and 1.5 billion valuation, and raising from Andreessen Horowitz and Kleiner Perkins and the who's who of Silicon Valley. Jon, thanks again. Folks, check out lendflow.com. Check out Lendflow demo days if you want to learn more. Great session. I had a ton of fun. Jon, thanks for staying a little past the top of the hour.
I enjoyed it, and that's that Loom story. That's conviction. That's going to be an exciting one. I got to be checking in back for that one too, because again, there's so much to learn from him and that journey as well. So love to hear that. Thanks for having me on. It was a good time. Until next one.
Until next one. Love and peace, my friend. Love and peace, everyone.
I need some traction.